Afternoon, everyone. Thank you for joining Special Small Strategies for Business Owners by Pace and Westpac Wealth Partners. We're going to give another minute or so that more people could join us. I can't believe this is already our third session.
Yeah, I know. Flies by.
I know.
And then we got to figure out the date for that retirement account one.
Yes, retirement account. I'm so excited for that topic. All right, it's 1 p.m. Just minutes. So let's get started. Good afternoon, everyone. Welcome to Smart Strategies for Business Owners 4-session webinar series by Pace and Westpac Wealth Partners. Today is the third session, and we'll talk about unique tax strategies for business owners. Very important topic. These webinars are designed to help entrepreneurs like you to make smarter decisions and avoid costly mistakes and build lasting value. My name is Jeannie Yang, and I'm a business loan counselor at Pace. Thank you all for joining us today. This webinar is brought to you in partnership with the City of LA Economic and Workforce Development Department, EWDD, and BusinessSource Pico-Union Westlake Region, operated by Pace Business Development Center. This webinar will be recorded, and at the end of the webinar, you'll be asked to participate on our survey. So please make sure that you complete the survey, as it's going to help us build the future webinars in a better way. And before we learn something new today, let me do a quick introduction and Pace. Pacific Asian Consortium and Employment. We are established in 1976. We are a 501c nonprofit organization. We offer one-on-one business counseling, credit, asset building, and business and financial plan development, webinars and training like today's to help you establish a brand new business from scratch or help your existing business. We can also guide you get into a procurement contracts if you're interested. And the greatest fact is that all our services are free of charge. So if you have any questions about our services, programs, or lending products, please visit our website, pacelabdc.org for more information. All right, our guest speaker today, Charbel, Daniel, and Jay. It's a pleasure to have you back with us. Let's get started.
Good to be here. Thank you for having us, Jeannie. And welcome, everybody. Good afternoon, or depending on where you're at. Well, most people are here in LA, so good afternoon. I'll just give you a brief intro, and then I'll have Daniel and Jake provide a quick intro. We're lucky to have Jake Alexander. He's an EA with Action Accounting. His knowledge of these strategies, along with our conversations, I think will be hopefully beneficial to you. So my name is Charbel. I am a financial advisor at Westpac Wealth Partners. I was also a fellow business owner for over 20 years. My brother and I had 9 restaurants in the LA area. So I definitely know how you're feeling at times and, you know, putting out fires every day. So we're just here to provide a little bit of support, a little bit of clarity as to hopefully things that could help you in the future and make you build better businesses and better futures for you and your family. So Daniel, if you want to go ahead just with a quick intro.
Hello, everyone. My name is Daniel Alvarez. I am a financial representative under Charbel's team. It's a pleasure to be here today, and look forward to these last 2 webinars, and also look forward to hearing from me via email just to follow up if you guys have any questions. All right, Jake.
Yeah, hey everyone, I'm Jake Alexander. Hey Charbel, thanks again for inviting me here today. And thank you all for taking some time out of your day to learn about stuff that's near and dear to our hearts. You know, I'm Jake Alexander. Action Accounting is the name of our business. We're a full service accounting firm based out of the Tampa Bay area. That's where I am in our office today, but we work with clients all over the country. And in our company, we have four main departments. We have a bookkeeping department, which helps business owners create financials so they can really understand how much money is coming into their business, how much is going out. We have a tax preparation business that helps prepare and file business tax returns and individual tax returns for respective owners of the business. We have a tax planning department, which is a lot of the concepts and things we're going to talk about here today. And then we also have a business consulting department too. We've been around for 10 years. We have a team of 8 of us now, and we would love to help you with as much of this stuff as possible along the way.
Perfect. Thank you, Jake. And just before we get started, a couple of housekeeping items. This is the webinar version of Zoom. So on the bottom there you can see there's chat has been deactivated. So what you're able to do is you're able to click on the Q&As where you welcome any questions throughout. We have Daniel manning it, and I'll keep an eye on it as well. Any questions for whoever's presenting that particular slide or on any slide. And then yeah, and then that's just and then we also have about a 15 to 20 minute Q&A at the end. But again, please, we don't mind stopping and chatting and getting a little bit deeper about what it is we're talking about currently. So the first thing I want to talk about, and I think I've talked about for the first 2 webinars, is the importance of coordinating advisors. So as a business owner, there's so many things going on, right? And most people have a CPA or a tax preparer, an attorney, an HR person. Sometimes they hire these things out. The important part, what we tell our business owners is whenever you want to make a financial decision, it's important to get views from different aspects, because one decision, if you just ask the CPA or if you just ask the attorney, you're going to get their point of view. It's important to understand what type of ripple effect that decision will have on your business and your personal side. And I think today is going to be a great example of that coordination of advisors. Jake is an extremely proactive planner. He is not looking at last year. Well, even he is to file your taxes, but definitely always looks forward. And so we want you to pay the least amount of tax over the long run. And it's not just about this year, it's about years coming up. So that's about it. Jake, anything else to add before we get started?
No, I would just add real quick, on the Q&A box, we do want to hear from you and we do want to interact with you throughout the webinar. If everyone, so we could just do a quick technology check. If you could just pull that Q&A box in there and maybe just type like your first name and what city it is that you're joining us from today. I always like to make sure that works ahead of time so we don't get 45 minutes into this and be like, oh, wow, nobody's had any questions, but for whatever reason, it wasn't quite working. So if you can hear us and you can find that Q&A box, do me a big favor, type in your first name and the city that you're calling in from. We would love that just to make sure that's working there. So that's the only thing I wanted to add. And then Warrior from Los Angeles, perfect. So we got it working.
Yep. Perfect. All right, so we did the intros. I guess I'll let people look at us real quick again. So Jake, the first webinar in this educational series that we did centered around entity selection. I'd love to still touch on it again today. A lot of times we hear, when is the right time as I'm starting the business, when is the right time to incorporate? And when I do so, what type of corporation should I be? Love to hear your thoughts on that.
Yeah, absolutely. The reality is there's a lot of different entities out there. So there's a lot of options out there. There's also a lot of varying opinions, or this is kind of one of those ones people come to us with concepts that they've heard on social media and those sort of things. My biggest advice when it comes to this is don't overcomplicate the entity structure. You definitely want to work with an expert to get that set up, but for whatever reason, sometimes people come to us and they've seen videos from online experts or any of this sort of things where they think that they need this overly complicated structure with like a holdings company based on one state that's owned by 2 different partnerships, and then everything flows through to a trust. At the end, a lot of times it doesn't need to be that complicated depending on what you have going on, but there's a lot of options out there. As a sole proprietor or a single member LLC, all of the income earned from that business is going to flow through to your personal tax return. And it also creates what is called self-employment tax on those earnings. So you're going to pay a little bit more taxes like that. A lot of times it makes sense to convert from being taxed as a single member LLC to an S Corp. That's typically when your net revenues are over about $50,000 per year. There are times where a partnership makes more sense, where if it's a husband and wife or some sort of spousal arrangement with the ownership of the business. And then lastly, there's a C Corp as well, which does cause double taxation. A lot of people don't realize that if you're taxed as a C Corp, that's one of the only entities where the entity itself pays taxes, and then you still personally pay taxes on the income that you take out of the business. So there's a lot of different options in there. Our general rule of thumb is to keep it simple, but it's mostly to work with an expert and have somebody set this up for you who knows exactly what your situation is and what you're trying to accomplish at the end of the day.
And I could start with one type of entity and then switch to something later as my business shifts, correct?
Absolutely. We can shift entities. We can also create new ones if it makes sense.
Got it. Perfect. Thank you. Yep. Here we go. All right. Now this bucket, I'm a fan of kind of this category of tax planning because number one, it was a way for me when I was a business owner to move money from my business to my personal, tax efficiently. A lot of times we dump all this money into our business, and then if we have money, then we're opening another business, right? At some point, we always tell the owner, okay, well, now I'm on this side of the advisor side, but it's time to start shifting some of these assets, some of the wealth from the business to the personal, kind of when you stop that or when the growth phase slows down, I want to say, right? So
Yeah.
I know in California, we have Cal Savers here. And so starting January 1st of 2026, I believe it's anybody with one or more employees will be required to have a qualified retirement plan. So just some thoughts here, Jake. I know that you're familiar with with all of these, right? Given kind of the Cal Savers coming up, any recommendations and would you go one way or the other? And plus there's Secure Act 2.0, right? Because that
Yep.
introduced a lot of tax credits for business owners. So I'd love to hear your thoughts here.
Absolutely. And there's a lot of options out there when it comes to this. The general rule of thumb is if you own a business, you absolutely need some sort of retirement plan. So it's a great source of tax deferral or tax savings, like Charbel was just saying. But also as a business owner, there's no one else building this retirement plan for you. It's not like when you're an employee at a big company and they have a 401k and that sort of stuff. So it's sort of twofold. It's an instant source of tax deductions up front and tax deferral, but then it's also building a retirement plan for yourself in the future. So you want to have some sort of plan. There's individual IRAs out there, which are the easiest to set up and sort of the easiest to manage, if you will. They've also got the lowest limits of what you can put in every year. There's a SEP IRA, like what's listed there on the slides. That stands for Simplified Employee Pension Plan. Those are great. A lot of people don't realize you can put up to $70,000 in those plans per year. That's money that's now a deduction from your business, and then it's growing in a tax deferred plan for you down the road. With the SEP IRA, there are some payroll amount to the owner limitations that we have to consider. So you have to be paying yourself somewhat of a higher wage to be able to max out that full 70,000. But those are great plans right there. There's a 401k or a solo K, which that happened to be, it's kind of like when we're talking about this stuff, it's kind of like your kids. You're not supposed to have a favorite, but everyone kind of has a little bit of a favorite. With the solo 401k plans, I love those. If you qualify, this is specifically for businesses that don't have any employees. But if a husband and wife or spouse work in the same business together, they can actually both contribute up to $70,000 per year into those plans. That's just an amazing source of tax deductions up front, and then it's growing in that retirement plan for them. So those are just a few of them. As the business grows, we may want to look at more of like the traditional defined benefit plan or the cash balance plans. With those, you can get like up to multiple six figures per year into those accounts. It's money, once again, you're not paying taxes on it in the business, and then it's growing in that retirement plan for you.
Got it. And one of the things is we're still trying to figure out, but according to Cal Savers, SEP IRAs do not qualify as having a retirement plan for the business. So that's one thing to consider. The other thing that we see a lot is some of these business owners have seen presentations and illustrations that show a 401k plan. The problem is it's unfortunately they've been shown a plan where they put $1 and maybe they get back 30 cents to account, and then 70 cents goes to the employees. What we try to do is we try to make sure that every dollar that's put in, the owners are getting somewhere around 80 to 90 cents on that dollar, so that it makes it less of a cost and more of a benefit. And then the employees still have that benefit. So there's a lot of ways to design it. Again, it all depends on your structure, your payroll, your cash flow. But yeah, thank you for that.
Yep.
All right, so this next section includes some of the deductions that were made quote unquote permanent with the one big beautiful bill, right? Permanent until the next administration or the next Congress changes something. But one of the top ones here that we see a lot is QBI. And I know that you're a big fan of QBI optimization, because most tax preparers, they just want you to pay whatever the reasonable salary is. And what we try to tell people to do, and sometimes we're sitting there arguing with these tax preparers, not arguing, but trying to debate, right? Let's put it that way.
Having constructive conversations.
There you go. There you go. Because number one, usually the tax preparer is the client's number one trusted advisor, right? So there is a level that sometimes could be above what the minimum payroll should be that maximizes this QBI deduction. Can you, I know this can get deep and I know we can go into a rabbit hole here, but can you give me kind of a quick, brief description of that QBI and just a couple of points about it?
Yeah, I would love to. And to your point, it does get really technical. I've racked my brain on the simplest way to explain this to clients and to people in these situations. But essentially, QBI stands for Qualified Business Income Deduction. At the end of the day, it's a 20% deduction from your net business income that you, as a business owner, get to take. So there's several portions or several categories that we can optimize to increase that that deduction and help you maximize it. Your owner's pay that you take as a salary, so like out of W-2 wages, not necessarily what you take out of distributions, has a major portion of it, and the W-2 wages that you pay to everyone else in the company. And so what we recommend is focusing on this all year long, basically, not working retroactively and trying to work the numbers there. This is one of those things we love working with people through. But the easiest way to explain it is a 20% deduction from your net business income that when you optimize and do it the right way, it can fully be maximized and it can add up to very large numbers for clients. So,
yeah, no, that's great. And one other thing I wanted to touch on here is just cost segregation. Just if you can give us kind of a brief description. I know as a business owner, one of my goals as I was growing my restaurants, eventually, I didn't end up doing it, but to buy the next property that my restaurant's going to be at, right? That's ideal because you're paying rent. Most of the time, your rent's going to be just as much as your mortgage on that property, right? And there's a lot of advantages there when it comes to, these cost segs and tax advantages. So I'd love to, again, I want to try to stay high level because this can get into the weeds, but love your thoughts on the cost seg.
Absolutely. And I will get into that too. I just want to double your thoughts on when a business owner is in a situation where they can buy the building that their business operates in. Typically, that creates a really good scenario for multiple purposes. It can create a really good scenario for tax deduction purposes, long-term wealth building,
Estate planning
purposes, and then estate planning, because we've seen situations where client can get to the point where they sell the business, but they still own the building that it operates in. So you can create another layer of income post-sale too. So not to get too far off topic, but I really love what you said about that. But for cost segregation, the easiest way to explain that is when you buy commercial real estate or certain types of residential real estate, you typically get to take depreciation on the building over either 27 or 39 and a half years. So what that means is they take the value of the building and divide it up over either one of those really big numbers. So it gives you a certain amount of a deduction every year divided by those numbers. When you do a cost segregation study, it's basically a fancy way of saying, okay, we're going to go in and we're going to pencil out all of the assets inside those buildings that can be depreciated over 5 or 7 years instead of 27 or 39. What that essentially lets you do is take those deductions a lot earlier. So we're going to accelerate the depreciation expense that we can take on that property. At the end of the day, it means that's money that you can write off in the current year. So if you're looking at investing in any type of real estate, a cost segregation study can make a lot of sense in certain scenarios.
Perfect. I love how you take the complicated and then you kind of give it, you speak English, you speak our language, right? It's like when you go to an attorney, you're like, okay, he talks to you for an hour and then you ask him, all right, can you just repeat everything you just said, but just in English, please?
Yeah, there you go, right?
So I appreciate you making it easy for us.
I try. Thank you.
Yeah. And then, so this next category, a lot of times depends on the operation of the business, right? What type of business that you have, the usage for it. There's certain tax credit that surprisingly a lot of business owners were not aware of. One of the top ones, I think, the R&D tax credit, what qualifies as research and development, but also the one big beautiful bill kind of gave us an opportunity now to go back a little bit and then have our cake and eat it too. So I'd love to just a quick, maybe the top two, I don't know. And if you think any of the other ones are just kind of worth diving a little bit deeper, please go ahead.
Yeah, no, absolutely. The R&D credits is a great one, stands for research and development. This one it's interesting where we speak with clients a lot and they had no idea that they were already doing these activities and paying for them, but they had no idea that they could actually qualify for these credits. So it's called the research and development credit. And it's essentially the IRS will allow you to take a credit for expenses spent on research and development. Now, it needs to be for specific things. It's for if you're creating a new system or process, developing a new software, or developing a new system that's to be used in some sort of like technological advancement in your business. So it's in layman's terms, if you're spending money on creating something new that doesn't exist, it could potentially qualify for an R&D tax credit. This is extremely popular with like software developers because 9 times out of 10, they're developing some new type of software that doesn't exist. We recently found out several months ago here in the Tampa Bay area, there's a lot of craft breweries everywhere. They can actually qualify because they're creating new strains of
that's
their alcohol.
Okay.
Yeah, I thought that was a pretty interesting one too, right? And so think along the lines of if you're innovating, if you're creating something new in your business to make it more sustainable for the future or things like that. A lot of like environmentalist type companies out there can qualify too. There's credits out there and they can be substantial. We were talking to a client the other day, went down this road to try to identify what costs would qualify. And we found out they spent like over $250,000 since the beginning of 2025 this year that we can qualify towards applying towards the credit for them. So just a little bit about that R&D for the energy credits. Those
Can I trouble you? Can I interrupt you there on the R&D?
Yep.
So let's say I'm a commercial plumbing business and I'm expanding and I'm bringing in a CRM that's gonna, I guess with it's because I'm not creating it, right? I would almost have to create my own CRM system to get that type of tax credit.
Great example. So if you were just purchasing a CRM and then instating it in your business, then I would still recommend doing that, but that wouldn't qualify for R&D. But if you were creating a new software that was the new latest and greatest CRM specifically for plumbing businesses, to match two softwares that already don't talk to each other, then that could potentially be it right there. So that's a great example. Just using an existing product would not qualify, but actually creating a new one is specifically what it's for. So
got it.
Yep. And if anyone else out there has questions, pop them in the Q&A. We can answer those either live on the spot or wait to the end. We've got plenty of time built in for Q&A too. So that's just a little bit on R&D credit. The energy credits, the EV for electric vehicles, that's one of the more popular ones. The One Big Beautiful Bill Act is bringing an end to that one. So if you do want to take advantage of that $7,500 credit for purchasing an electric vehicle, that's expiring September 30th of 2025. So that's one you'd have to get on pretty quick to be able to maximize that, or have already purchased a vehicle at some time during this year. So
because even for the solar, I believe it has to be installed and running, right? It's
correct. So yep, the vehicle credit expires September 30th, 2025 for the solar for your house. You do have to the end of the year, but it has to be installed and in operation to be able to take advantage of that. So
Got it. Thank you. Yeah, and depending on operations, right, there could be other tax credits that you qualify for. So make sure you contact your team and say, hey, what could I possibly qualify for given my operations?
yeah, there's one out there that work opportunity credit towards the bottom there. That is for industries that hire certain demographics of employees. So we've seen clients in these kind of situations where, if they're more of like a staffing company or somebody who has higher types of rollover in their company, if they specialize in hiring a certain demographic of employees, you can get a credit for each one of those employees you hire. So that's just a small example of there's a lot of different stuff out there. You really want to be working with somebody who's digging in and asking you these questions to help you just kind of uncover that there's a ton of stuff out there, right? So not all of it's going to qualify or pertain to you, but you want to be working with somebody who's asking the right questions to uncover exactly what pertains to you and what would help you in your business. So,
and we have a question here. I just wanted to make sure that you saw that. What if an entrepreneur is not producing software, but has created a new tangible system and an app to solve a persistent societal issue or problem? Would the R&D tax credit apply in this case? Because I know
awesome.
it has to satisfy like those four things, right? And it gets a little complicated, but
Yeah.
I guess that would that work?
It could quite possibly something like that. We have like kind of like an example worksheet that we walk through with clients with a series of yes or no questions. I'd love to connect after this and kind of go through that with them and see if it is, but potentially, yeah, it could absolutely.
Okay, perfect. Do you guys do R&D tax credits, or do you work with a third-party firm that does it?
We do. So currently we have a third party firm that we are working with. That's specifically what they do and what they handle. Our goal is to bring that in house by the end of this year. So,
And usually what happens is they take a percentage of what you get back, right? So if they don't get you back anything and you don't qualify, they don't pay.
yep, is exactly how it works. So,
Okay. And another question, can you please give us an opportunity of work, an example of work opportunity credit?
so for work opportunity credits, hiring certain demographics of employees. I know veterans is on the list. I know people who have like felonies on their records or certain types of misdemeanors and those sort of things are just a few of the demographics that qualify. And so you
And I
hire.
know what I did towards the end of my business is I, got a kind of a bigger payroll company, right? Not your mom and shop payroll or not my accountant doing my payroll. And a lot of those payroll companies have an onboarding questionnaire that actually identifies those employees for you. So it's even part of the resume, you know, like once you obtain the resumes, they could actually take a bunch of information from that and then ask a few extra questions so that you'll know as you're interviewing who would qualify and who wouldn't.
Yep, that's great advice.
Yeah. All right. Next up, this is probably the most asked question from our business owners, right? Is can I put my kids on payroll, right? All these TikTok videos showing, people buying Ferraris and putting a logo on it and advertising the business, and now they can expense the whole thing, right? But now instead of the Ferrari, it's my, 5-year-old. So what are your thoughts on kids on payroll? And I have some thoughts with that as well, but I'll add that after. And then what is the most efficient way to help, I guess, start shifting income to your kids and, having them build wealth?
Yeah, absolutely. And I love this one too, because we do get the question a lot. The answer is yes, you can do it if it makes sense and you do it the right way. So, a lot of people don't realize your children can work for you in your business. If you pay them up to $15,000 per year, that money can be a deduction from the business and then tax free to them as the children if it's their only income. They have to perform an actual role in the business and you have to pay them in line with going market rates. So if we kind of take a step back and break that down, the biggest thing we hear out there is, I think you alluded to it a little bit, is paying the children for marketing of, hey, if I've got a 6-month-old, and because they're my child, I think they're the most adorable 6-year-old in the world. And I post a picture of them on Facebook, is that enough to substantiate a marketing fee of $15,000 for the whole year? My answer to that would be no, right? Because you
But they're
wouldn't.
really cute, Jake.
Yeah, I understand, and I think they're cute too, but the IRS is not as they're not as entertaining and forgiving on that one
Yeah.
as you and me, Charbel, would be. So I get it. I'm
Yeah.
on your side with that one. I think my kids are cute too, but in reality, they have to perform an actual role in the business. You got to pay them in line with going market rates, and so I kind of use that example to set a stage of like an extreme example where if we did want to be really aggressive and say our kids were doing marketing and that sort of stuff, and if we used a number of pictures or we had them like actually filming, at one point there was those AI videos of the baby's mouth talking with the adult's words. If we wanted to get creative and do that and pay them maybe $1,000 or $1,500 per session or something like that, we could tend to make that work. Where this really makes the most sense is when they get to that, probably between like 8 and 12 range, and they can actually do basic administrative duties for you in the business. You could pay them to clean your home office. There's a lot of things out there that you could do to do this the right way. And you can pay your kids the up to $15,000 per year. It's a deduction from the business. It's tax free to them. If you want to take it to the next level, you work with somebody like Charbel to set up like a Roth IRA for them where they can start building investments in their own portfolio. You can look at all sorts of different options that you can do out there, but it's got to make sense. You've got to have all the paperwork to substantiate it, and it's got to be something that we could justify to the IRS at the end of the day if we had to. So,
And that's where the putting the kids as direct owners, of if it's an LLC, for example, where they can be the percentage of profits doesn't have to do anything with the percentage of ownership, where it comes into play. Also, you don't have to justify if they're doing any work because as owners, they would be getting those distributions. Plus, it's used in our next slide where we talk about estate planning. It could also be used as an estate planning tool to slowly shift assets of a business that's going to be sold in the future to these kids and to these trusts in the names of the kids. So there's definitely a lot of planning opportunities here. The one question I get, and if we could go back, so it's usually if they're not owners, you have two options to pay them: payroll or 1099. What are your thoughts on paying your kids 1099? Because if they file their own tax return and there's the whatever you call it, the standard deduction, right? As long as you pay them right around the standard deduction, there should be no self-employment tax.
yep. And I'm glad you asked that question because a lot of people get, this is kind of where it gets a little more detailed. So if your business is taxed as an S corporation, then technically you would have to pay them as a W-2 employee. When you do that, you're going to pay that 15.3%. It's now called payroll tax, but it's the FICA and Medicare taxes on whatever you pay them. Even if you have to do that, you're still going to get a deduction for the wages that would offset the 15.3%. But if we pay them, if you're set up with a different entity, you may be able to pay them as a 1099, which if they're under the age of 18, then the FICA and Medicare taxes wouldn't apply and you could bypass all of that right there. So there's several different ways to do it based on how your entity is structured. You want to work with somebody to make sure you're filing all the paperwork the right way though.
Got it. And one of the last things I just wanted to touch on, I know I'll run through the next slides a little quicker, but I think this one's important. The last one with the intellectual property. And I think it is an incredible tax planning strategy that not a lot of people take advantage of. I'll give you a perfect example. We had a client that, had a restaurant, and the restaurant, had 4 locations. And so as a brand and as the restaurant continues to grow, the brand has value. That logo, that name has value. So there are opportunities, and correct me if I'm wrong, where you could have ownership of that IP in different domiciles in different states that are taxed differently, and have all the locations really pay a licensing fee to this entity that owns this IP. I know this is getting into the weeds, but IP type planning, I think, is something that's extremely underutilized. Any thoughts? I mean, I know you've done that too in the past.
Yeah. No, I love that you brought that up. And so in a situation like this, you think of, I love the great state of California just as much as all of you do, but there are some heavier state taxes there. So kind of the example that Charbel is painting is if we were to parcel out the intellectual property of your company and have that based under a company that doesn't have state taxes like Nevada, Texas, Florida, we can potentially avoid a large amount in the state income taxes in that planning. So there's several different ways to do it. The example you provided, I think, is a great one. We see it done with intellectual property. We also see it done with businesses that have a lot of assets, like manufacturing facilities, or even in those sort
Equipment,
of
a lot
things
of
too. So,
equipment too, yeah.
yep, it's really just at the end of the day, getting creative, understanding that there are a lot of different options out there when
Yeah.
it comes to this stuff.
Yeah, and we call it our sunshine tax. So we're okay paying it, even though you guys probably just have as much sunshine as we do. So
There you go. I love it. I love it.
So the estate planning, this is where it comes in from an asset protection point. I guess as you continue to grow your business. Okay, let me take a step back. Just regular estate planning, all it means is giving what you have to who you want, when you want, under the terms and conditions that you want. That is really estate planning in kind of the simplest form. It bypasses probate, right? And then also, if you have young kids, it tells the courts what should happen to your kids. And California probate court's expensive and it's long. But then there's another level once you start building that wealth of, okay, how do I protect my assets from business liability and vice versa? How do I start separating all of these different assets? So advanced estate planning in multiple states, for multiple beneficiaries could be also an incredible planning tool. So that's all I kind of just wanted to say about that. I don't want to get too far in the weeds on here with all these acronyms of BDITs and NINGs and ILITs and all that. But anything to add on the estate planning front? Because look, for coordinating advisors, it's important to have your attorney, your tax preparer, your financial advisor really chatting together. And since we don't have an attorney here that can go deeper into this, it's something that we should definitely, or your team should definitely be involved when you're talking to an estate planning attorney, because it does have tax consequences to these plans, to these different trusts.
Yep, I agree with you.
Okay. Just for time's sake, I'm gonna run through a little bit faster here. Real estate, right? We all know, we already talked a little bit about the cost segregation, and what we find most often talking to a business owner is they usually want to put their money back into either their business and growing it or real estate. That was what my goals were when I was a business owner. And so I just wanted to expand my business and then use that money to buy real estate, because everybody talks about real estate as the greatest tax benefit ever. But there are certain limitations here with that difference of income. And so I'd love if you could just give us a brief description of maybe some of that hurdle.
Yep. So a lot of people don't realize, I guess, let me back up. So purchasing real estate can be a great way to build wealth long term. I firmly believe that. A lot of clients don't realize when you're purchasing long-term rentals, which is if you're purchasing like a residential rental property and leasing it out for a year at a time, those properties will create tax losses on your tax returns, more than likely because of the depreciation. However, once your income gets over $150,000 per year, and that's combined with you and your spouse, those losses now start to roll over. They don't give you credit for them in the current year. And so I say that because a lot of clients don't realize that when they come to us, that those losses will start to carry over, not give them instant credit unless the property qualifies as a short-term rental, which what qualifies there is the average rental period being 7 days or less. So that's more like an Airbnb property or a beach condo or mountain condo or something like that. Then the depreciation losses generated for it can help you out in the current year. Or if you qualify as a real estate professional, which to do that, there's several different tests that you need to qualify for. What that basically means is it's your full-time job working in real estate to be able to create the income from it. So I wholeheartedly believe that real estate is a great way to build wealth long term. When it comes to the tax perspective, you want to just make sure you're set up properly and you know what to expect. So,
and we have a question here. I just wanted to, it has to do with the IP conversation.
oh
If
yeah.
you're in business for years and then only now claim kind of the sunshine tax opportunities to brand name and machinery, does that automatically wave a red flag to IRS and trigger an audit?
Does not automatically raise a red flag. Everything we do has to make sense and has to be justified, right? So, in my opinion, as long as what we're doing makes sense and can be justified, even if it did raise a red flag, as long as we had all of the documentation in place to justify everything, there would be nothing to worry about. So, simply taking advantage of a new strategy just because you haven't in the past is never, in my opinion, a reason not to do it. Because when we do it, we're going to make sure we do it the right way, and we're going to make sure we have everything ironclad to be able to justify it. So the short answer is no, it wouldn't be an instant red flag as long as we were doing everything correctly and had it all set up correctly in the documentation to be able to justify it.
I love that. That's a perfect answer. And all right, next up, I'm going to skip the bottom two just for time purposes. So charitable giving, another great tax planning tool. But what I always tell clients is the tax advantages of this type of planning should be second. Charitable inclination should be first, right? If you're charitably inclined, that's phenomenal. And then there are tax advantages to that of how things can be set up depending on the asset, right? I know you have some experience also with private foundations and donor advised funds. So I'd love just kind of, you got 60 seconds to give me your thoughts on charitable giving.
So I love that. We put a time on it. When you make a lot of money, you either spend it or you pay taxes on it. This is the reason a lot of very successful people have private foundations like the Bill and Linda Gates Foundation or like the Clinton Foundation. You can actually set up what's called a private foundation, which is basically a charity, but it's specifically set up to shelter your own income and then be able to disperse it as you please. So it's a private foundation is a fancy way of setting up a charity for yourself. There are a lot of regulations. There's certain things you can and cannot do with the funds while you're there, but you're essentially being able to donate money to your private foundation and take it as a tax deduction. For donor advised funds, that's sort of a step in the direction of the private foundation, but not as fancy or not as restrictive when it comes to the paperwork. Those are funds that are already set up out there where you can make a contribution to them in 1 year. So you can make a rather larger contribution to these funds in 1 year and then have some say in how those funds are used over the next, say, 3 to 5 years within the organization. So
Perfect. That was about 75 seconds, but that's
I was going to say, did I go over?
Couple more slides and then I think we'll open it up for a Q&A. So this particular kind of category deals with the investments and also the efficiency and optimization of investments. So to give you a great example, there's certain cash that stays in the business account. Some contractors, for example, our clients keep a lot more cash. So some industries keep a lot more cash on hand than others. How you invest that cash as a business, whether you put it in treasuries or money market, they have different taxations on both. So we want to make sure, looking at the cash flow, looking at the investment accounts, are you getting paid for the amount of risk that you're taking, number one. Number two, is there a better place for this cash for you on an efficiency and optimization level? So a lot of times you can put your money into some really safe investments that have federal and state tax benefits, right? And possibly still get some of that liquidity that you need. Maybe you don't need the whole money in there to be liquid. So that's something that we look at. Also, as you can getting closer to exiting, and you have a retirement account for you and for your business or from previous jobs, how are we going to maximize your distributions out of that over the next, hopefully 30 years? One thing that's happening, Jake, is I think it's official now that people are, with the increase in living years, I forget, oh my gosh, I can't think of the term, but people are living longer and people are starting to retire a little bit earlier, where some people will actually be in retirement longer than they'll be working. So an
Wow.
interesting thing to
Yeah.
plan for, right? Because one of the biggest concerns for business owners or anybody else is, am I going to run out of money in retirement? And so if your retirement's 20 years and then next thing you know, now your retirement's 35, well, that's a
big
much
difference.
longer,
Yeah.
yeah. So it's a much longer time horizon to have to plan for. So just wanted to run through that. Do you have any thoughts here?
No, I love it. I think you described it perfectly.
And then I know it was a lot today. I know a lot of information. This is kind of the tip of the iceberg on the planning, because we could have gotten literally each one of those categories could have had its own 60-minute webinar, and Jake and I would have filled it easily, right? The point is to build a team and to use your advisors that you have entrusted, and to use us as a resource, to use Pace as a resource. Use your resources. We don't know what we don't know. And so it's important to talk to different advisors and try to put them together and build the team, so that next time you make a decision, you're able to look at the pros and cons from several different advisors, so that there is that ripple effect is a positive one throughout your personal and business finance. So, but we talked about buy-sell agreements a couple of weeks ago. Actually, it was last week. There's a lot of things to retain key employees, right? That's saving business value. So as you continue to grow your business, at some point you're going to tell yourself, okay, I want to sell 5 years from now, but I can't get rid of John Smith. I need John Smith to be with me all the way, because he's my top salesman. And without him, the business is worth 20-30% less. And so what can be done to do that? And there are ways around that. So, and that could be another webinar topic, right? Business retention or employee retention. But that's all that we have. It's really just wanted to wrap it up. Anything else to wrap up before we open it up for questions?
I think it's great. I love how you guys are doing this as like an educational series. I just want to say thank you to everybody who jumped on, and applaud you for taking time out of your day to learn this stuff. Like Charbel said, there is a lot to it.
Yeah.
You know, this is kind of the tip of the iceberg. So if there's anything I can do to help in the future, I'm more than happy to have conversations and work with people to get them moving in the right direction. So thank you so much for having me today.
Yeah.
Thank you so
Thank you
much,
for
Jake and Charbel. Are we up for a question Q&A session now?
Yeah, well, I've been watching the chat. I know there's a bunch of people that asked throughout, so I kind of interrupted Jake and we asked them there. But we'll give it a couple of minutes to see if anybody comes up with any questions.
All right.
If
Well,
not,
that
I
was
think we have
questions.
our next one next week, right? For
Uh-huh.
exit planning.
Yes. I actually have a question.
Yes.
I deal with so many entrepreneurs and the startup sole proprietors, and most of the time they don't have their brick and mortar store, offsite, business place yet, and they often get combined with their living spaces with the workspaces, and using their own cars for utilize as their means of vehicle for their businesses. Is there any way to get benefits or take advantage, or between
Absolutely.
your personal assets to your business assets? Is there any way to get benefits from it?
Absolutely. I love that question. The best way I can describe it is the IRS is not so concerned with how assets are owned. They're more concerned with their use, and the IRS calls it a business use percentage. So you can be a sole proprietor, not have an LLC set up, but you're running some sort of side business. You could still qualify for like a home office deduction. You could still qualify for vehicle deductions. You could qualify for almost every deduction out there still. The key to taking advantage of it is just to have good record keeping, and be able to track those expenses as much as possible. We always recommend eventually people have a separate business bank account where all of the business income, business expenses are coming through. In the beginning, if you haven't set up an entity, the best thing you could do is just set up a separate checking account at whatever your regular bank is, so you have a separate account where all those expenses are coming through. And then we could absolutely show them how to deduct them at the end of the year too. So
Great to know. That's
yeah, great question.
And we have a question that came in, which this is the reason why I switched it to this slide. It said, please place links in the chat for attendees who didn't have QR codes. So so here's Jake's information, his email and phone number, along with mine and Daniel's. So hopefully that helps.
Yes.
Yeah, and
it
then I'll
does.
put two.
Yeah, I was just going to ask you, go ahead and put, your info there too.
Yeah, I'll type it in the chat. That goes to our website. There's plenty of educational videos, more of this kind of stuff on there. And then there's even a link that goes right to my calendar. If anyone wants to book an appointment and have a conversation about their specific situation, I'd be more than happy to oblige there as well.
Great. I was so into webinar, I forgot to type in the clause. The recording of today's webinar will be available later time under our website, psalabdc.org. So make sure you recap great information as we discussed today.
The other thing I wanted to add, Jake, is in LA County, I think you have a few clients here, but our deadline is October 15th for all taxes, corporate, personal payments, any quarterlies up until now, October 15th because of the fires.
Yep.
So this is still in the heart for these business owners, the heart of tax season, because I'm sure a lot of them are still waiting till like October 14th.
I totally have sympathy for everything you guys went through out there. Is really crazy. We are here in Florida. This is actually the first year that we've had a regular deadline since 2020. So when COVID happened, that started pushing the deadlines. And then since then, we have hurricanes over here, kind of like you guys have the fires out there. Every year there's been a hurricane right around this time that's backed our deadlines out to like February of the next year. So this is the first year, fingers crossed, as long as something doesn't come and happen, that we'll actually have a regular deadline in like the past 5 years. So
Jeannie, I think, let me see, is there another one? No.
I think we've answered all the questions.
Yeah, I mean, if any questions come up after, please let us know.
Okay,
We're here as a resource.
You can contact Jake, Charbel, Danielle directly, or you can email me directly and I'll pass on the questions.
Perfect.
All right, so if there's no more questions, folks, we have another webinar coming up next week, same time, Wednesday, 1 p.m. And we'll be talking about protecting your business for you. So please don't forget to join us next week. All right, I guess that's it for today.
Thank you, everybody.
Thank you.
thank you so much. Have a great day.
Thank you, Jason. Thank you, Daniel. Bye. See you next week.
Bye.